If I told you there's a way to know exactly how much home you can afford without filling out a loan application or having your credit pulled, you might think I'm insane, when in fact, knowing how much you can afford can easily be calculated at home through your debt-to-income ratio. If you're thinking about buying a home, you need to understand your debt-to-income ratio. DTI is a key aspect of your home purchase because lenders use DTI to determine how much money you can afford to borrow for a mortgage. In this video, I'm going to explain what DTI is, what aspects of your finances are included, and how to calculate it. So if you're ready to learn more about DTI and how it can affect your ability to buy a home, let's get into it. When we break it down, to calculate your debt to income ratio, you'll take your monthly debt payments, divide them by your gross monthly income, and multiply that by 100. This may not mean much to you now, but we're gonna work through some examples together in just a minute. Lenders use DTI because they wanna make sure that you can afford your monthly mortgage payments. If your DTI is too high, then it means that you are already spending a large portion of your income on debt payments. This could make it difficult for you to make a mortgage payment if your income decreases or your expenses increase. In general, lenders want your DTI, including your mortgage payment, to be below 43%. If your DTI is higher than 43%, you may still be able to qualify for a mortgage, but you'd likely have to pay a higher interest rate. So that you can get a better understanding of how to calculate your debt to income ratio, let's talk about what's included versus omitted in the calculation. When I mention debt payments, I know that is very broad. So let's first talk about some of the items that are included in your debt payments from a DTI perspective. Lenders are going to look at car payments that you have. They're also going to look at student loans. Now, with student loans, there are so many different ways that lenders look at this, and how they view student loans and how that factors into your DTI overall depends on the loan type that you end up pursuing. So the three main things that I want you to know here is that if you are looking at an FHA or USDA loan, lenders are going to use 0.5% of your total student loan balance as a monthly payment in your debt payments. Lenders are going to use and need to factor in a student loan payment even if you have not started paying on your student loans. Even if you are in deferment, they are going to factor them in one way or another. So if you are pursuing an FHA or USDA loan, they're going to use 0.5%. If you are going to do a conventional loan, they're going to take 1% of your loan balance and use that as a monthly payment in your debt payments. If you are pursuing a VA loan, they're going to take 5% of that loan balance, and then they're going to divide that by 12 to get a monthly payment. The only way to not have one of these factored into your monthly debt payments if you have student loans is by having already a fully amortized repayment schedule for your student loans. So an example of that would be if I was on an income-based repayment plan to where, let's say, I'm paying $90 a month on my student loans. If I have a record of paying that and that is reported to my credit, the lenders would then be able to use that $90 payment. However, like I mentioned, if you are in deferment, you haven't started paying on those student loans, keep these percentages in mind because that is how they are going to factor into your debt payments. This may make a little bit more sense when we work through an actual example together. Now, another thing that's included, credit card payments. They are only going to look at your minimum payment monthly. So I don't care about what your balance is. If you owe $2,000 on your credit card, they're not going to take $2,000 and put that in your monthly debt payments. They're going to look at what is your minimum amount due that month that you must pay. Usually this is like $20, $50. Other things that are included in this are child support payments. So if you are responsible for actually paying out child support each month, that is in here as a debt payment. Also, alimony payments. If you have any personal loans, your monthly payment on those personal loans would be factored into this. If you have co-signed on any loans, mortgages, car loans, anything like that, those monthly payments are going to need to be included in your debt to income ratio. The other thing is mortgage payments. This goes for any property that you currently own that you will not be selling in order to buy the next house. This also goes for your future home that you will be purchasing. Remember, I said that lenders like to see a debt to income of 43% or less. They want that 43% to include your potential payment for your house. So some of the items that are not going to be included in this debt payments are going to be things like utilities, car insurance, cell phone bills, cable and internet bills, health insurance, groceries, rent. You do not have to take any of those into consideration or work them in with your monthly debt payments. So now that we have talked about debt payments, which is the first portion of our DTI calculation, let's go ahead and focus on gross monthly income. How are we going to figure out that and what counts for it? So just like we had several different things that would or would not be included in debt payments, the same is true with income. Some of the included items are wages, salaries, tips, bonuses, pension, Social Security. If you receive child support, that is seen as an income source. Remember, if you're paying out child support or alimony, that is a debt payment. If you are receiving child support each month, that is an income source, and that income can be used as qualifying income for a mortgage. I want to go ahead and make one statement here. If you have a side hustle income with less than a 2-year history is not going to be included in this income sources. This means that a lender is not going to be able to use that income for a basis of qualifying you. Of course, if you are a driver for DoorDash and you have been making money on the side, can you save up that money and use that money for closing costs or for a down payment? Absolutely, 100%. But they cannot use that income as like, okay, we can count on Nicole making $2,000 a month and use that income for qualifying for a loan. Since it's not steady unless you can prove that you've been doing it for 2 years. You've been paying taxes and everything on that income for 2 years. So just keep that in mind. So let's go ahead and work through like a real life example, which I think is going to help you guys connect all of the dots here. Let's say that I have a salary of $75,000 a year. Since we are using gross monthly income for our debt to income calculation, that would mean that I have $6,250 per month in income. That gross monthly income is your before tax income. So if I'm going back and I'm looking through the debt payments list, I'm thinking to myself, okay, I've got a car payment, I've got a student loan, I pay on my credit cards. So let me think about those numbers for myself. So let's say that my car payment is $350 a month. That would be factored in to my DTI. Student loan. Let's say my student loan balance is $20,000. Keep in mind, like we talked about before, different loan types are going to use your student loans differently. So if I were to pursue a conventional loan, that would mean that I would take 1% of my loan balance unless I have a fully amortized repayment schedule. Let's say I don't. Let's say I'm in deferment. I haven't started paying on these yet. I would go ahead and take a $200 payment for a conventional loan. If I was trying to pursue FHA or USDA, that would be a $100 payment because it would be 0.5%. Okay, let's say I also have credit cards that I have a balance on, remember with credit cards, it's not your total balance that's taken into consideration, it is your minimum monthly payment. So let's say my minimum monthly payment is $60. So for our debt to income ratio, keep in mind that is what is our monthly debt payments divided by gross monthly income. My monthly debt payments here are my $350 car payment plus my student loan payment. Let's say I'm pursuing FHA, so I'm going to add in $100 a month. Then I have my minimum credit card payment. Okay, we're going to divide that by my gross monthly income. That was the $62.50. So what does that turn into? All of these three add up to $510 that I have in debts, divided by my income of $62.50. That equals 0.08. Remember, we multiply that by 100 to get our DTI, debt to income ratio, and that would be 8%. So right now, given this situation, my DTI is at 8%. Now, where this really starts getting fun is that we know that lenders like to see a maximum DTI of 43% or less, and that would include your mortgage payment. So if I know that the max DTI allowed is 43%, what I can do, let me get a different marker here, is take my income. So let's take $62.50 and multiply that by 43%, which would be 0.43. That is going to give me $2,687.50. All right, here is where the fun part comes in. I can take this number, which is my 43%, my safety number when it comes to what lenders like to see, and I can subtract from that what? My total monthly debt payments. Because when I take what I can have as my debt payments, subtract what I'm currently paying out, what will that give me? That'll give me the amount that I could pay each month towards a housing payment. So I'm going to take my $2,687.50, subtract 510, and that's going to give me $2,177.50. This right here is how much I can afford on a monthly basis given my $75,000 income with my current debt load. Now this payment right here is not just my principal and interest. This needs to include principal, interest, taxes, and insurance on your home. Also, if you are buying a home that isn't in the HOA dues need to be factored into this as well. This is going to be a little bit of a longer video, but I think it would be beneficial if we worked through another example where you have a co-borrower. So maybe you're buying a house with your spouse, your significant other. So let's say this is you over here, and this is your significant other. I'm going to go ahead and write out a situation, and then we'll fast forward and go from there. Alrighty, so let's work through this example. Let's say that you earn a salary of $40,000 a year. Keep in mind we need to use the gross monthly income, so we break that down to what it would be per month. You have a car payment of $400 a month. You have a total of $60,000 in student loans, and you have a minimum balance on your credit card that you have to pay, minimum due of $120 a month. Then your significant other is not salary, they're hourly, but their wages come to $45,000 a year. That would be just over $3,700 a month. They also just bought themselves a really nice new truck, despite you trying to plan for a house, and that is costing $815 a month. They also have credit cards, and the minimum payments on those is $250 a month. So if you are working out your debt to income ratio with a co-applicant, what you're going to do is you are going to add all the income together and all the debts together. So there's no way for you to have a co-applicant on a loan where you're not involving their income, their debts, and their credit score. You can't just use their credit, just use their income for the basis of qualifying. It is worth noting though that just because you're married or in a relationship with someone, if someone is very debt heavy, you don't have to add them to the loan. You can always buy a house and finance it by yourself, even if you're married, even if you want joint ownership. If someone is not looking good on debt to income and kind of sinking the DTI ship, you can take them off and try to finance it on just someone who has a better debt to income ratio. So what we're going to do is we're going to go ahead and add up all the monthly debt payments between the two. So over here, we've got a $400 car payment plus student loans here, $60,000. What are we going to do with that balance? Remember, different situations for different loan types we're pursuing. Let's go ahead and say that we're pursuing an FHA again. So we're going to use 0.5%. 0.5% of that 60,000 would be $300 a month. So let's add that in. We're going to go ahead and add in that monthly payment towards the credit cards as well. Okay, now moving forward, we're going to go ahead and add this $815 a month truck payment. I hope that's a nice shiny truck. Credit cards, we're going to add in that $250 payment. Okay, we're going to do all of this over the gross monthly income. So it's going to be that $3,333 plus the $3,750. Okay, what is that going to turn into? It's going to turn into a total of $1,885 over $7,083. When we divide this out, it's going to give us 0.26. Remember, we're going to multiply that by 100. And what does that mean? We have a debt to income ratio between these two people of 26%. This is a little bit higher than our last example. So what does that mean when we want to buy a house? Well, knowing that we are smart home buyers and a lender ideally wants us to be at 43% of our gross monthly income or lower, we're going to take 43% of our total, which is the income between the two of us, $7,083. That comes out to $3,045.69. Okay, so we're going to take that amount and we're going to subtract the total debts between the two of us, which was this $1,885. Subtract that, you get $1,160.69. This is the amount that this couple here could afford for their principal, interest, taxes, and insurance payment. If you're following me on the math, the next thing that I want you to do is follow me to a mortgage calculator on Zillow, Realtor.com, whatever your go-to platform is. So let's head over to Zillow or an equivalent website where you can browse homes for sale in your specific area. And go ahead and pull one up if you are working through your specific DTI with me. So I've gone ahead and just pulled this listing up. This is a listing that I currently have. If anyone's looking for a great home in Sherwood, you know how to contact me. But what I wanted to show you is if you scroll down on most of these sites, you will get to a section where you can see the monthly cost associated with buying this home. And this is where we are going to get a little bit further and use that DTI to actually see what kind of homes you could buy given your current finances. So the biggest thing is you're going to see an estimated monthly cost. This is always going to assume that you are putting a 20% down payment down. Do you have $59,000 to put down on a house? I don't currently. And given the example that we just did, we were working with an FHA loan. So the couple in the example that we just did was anticipating that they were getting an FHA loan. So they were probably putting down 3.5%. So let's go ahead and change this to 3.5% down. This is automatically going to change the down payment figure. And as you can see, it's going to increase the monthly cost of this home. The biggest reason is because obviously we're putting less down, so we're financing more. In addition to that, you now have mortgage insurance because you're putting less than 20% down and using an FHA loan. The reason that I like these calculators though is because it is going to take into consideration, the principal and interest, the taxes, the insurance, the mortgage insurance. It's going to take into consideration your HOA fees as well, because those are also going to be a part of your DTI calculation. Now, there are ways to tweak this so that you could figure out exactly what priced home you can afford in your market. In the example that we just did, the couple only had just over $1,100 that could go towards their home payment every single month. So if we want to figure out, but while maintaining that minimum of a 3.5% down payment, what total home price they could afford, we need to start tweaking these numbers. So if we drop this down to 200,000, you could see, okay, we are getting closer here. We need to look at this estimated monthly cost, because that's going to be the total of all of these figures, not just the principal and interest. So let's go ahead and drop this down to, let's say 140,000. See if that makes a difference. Okay, here we go. Now we're down to just over $1,000. So the couple who is, paying a lot of money on their truck and their car payments and credit cards and student loans could only currently afford, probably in my market, about a $140,000 home. Hopefully I've made this easy to understand, and with these calculators, you can see in your area, what you're going to be able to afford, because these costs, especially like property taxes, home insurance, and your HOA fees, are going to vary greatly depending on your market. In Arkansas, our property taxes are fairly low, like $91 a month for this property. HOA is tiny as well. But in some markets, you might see an HOA of $400 a month. Obviously, that's going to take up a huge portion of your debt to income ratio, a huge amount of your available income. So I wanted to show you this as an easy way for you to tangibly see, given your financials, what that relates to in the real world. If you understand your debt to income ratio and credit score, there's nothing stopping you from getting approved for a home loan. Sure, this calculation may reveal that you cannot afford the home that you want right now, but knowing that information is a valuable step to getting your finances where they need to be to achieve your home goals. Let me know what additional questions you have about debt to income ratio in the comments below. If this video has shown you that your debt to income ratio is right where it should be, don't forget to head to the description of this video where you will find links to starting a loan application and finding a realtor. I'm Nicole Nark with videos to help you find your way home. Remember to subscribe to my channel and hit the notification bell so you never miss an update. Stay tuned for more helpful content, and I will see you in the next one.